Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So the inflation, the prices in the United States, we got a data called the CPI, Consumer Price Index, come out on Thursday, basically came in line, which is as expected, right? When you look at the month-over-month numbers, the core and the headlines, taking into consideration the energy prices for the headline, came in line. So no change, no surprise there. When you look at the year-over-year numbers, slightly down, about 0.1. So again, no change. And most importantly, the super core number, which the Fed is tracking, and which is also very important for the markets and for everyone looking at inflation, because apparently the Fed told us that it's going to make most of its decision looking at the super core number. And what the super core number is just simply taking out shelter, the shelter component out of the core component, and they say that, hey, since shelter is very sticky, we want to look at the other all the other core components, just removing the shelter, which came in basically in line also. However, higher than the previous months, right? Previous months was basically zero. And no change in increase. However, this number came in at 0.19, so about 0.2, let's say, and again, as expected. So it was higher than the previous months, which some people may argue that, hey, this is, not good, right? That means that the Fed continues or should continue to tighten or continue to leave things tight for some time. Others say, hey, it's in line, it's not a big deal, right? So what was the reaction in the stock market and the bond market? Well, when you look at stocks and bonds, initially it was all over the place, right? We had a rally, then a sell-off. So let's talk about stocks first here, right? Stocks went up, sold off, and then after 9:30 when the markets opened, completely rallied, went to the highs of the previous day and found a resistance there, and then completely sell off and make a low on the day. Same thing with bonds. Bonds rallied, it sold off, almost made a low, went back up to the 50% fib level, and then later in the day completely collapse and sell. So you got stocks, you got bonds completely selling off on this data. Now what does that mean, right? When bonds sell off, it basically means higher yields, right? You push the yields higher, and especially on the long end was selling off more than the short end. I'll talk about that phenomenon in another video, which will come up very shortly this week. But I'll talk about the idea of the yield curve and how the long end is being affected more about the short end and what that can mean. But overall, looking at the reaction of the stock market and the bond market, they're basically shrugging off this number and saying that, yeah, initially went up, looked good and everything, but it's not enough, right? And it's not enough to figure out whether this is a pause or not, because we did get it here from the Fed members saying that they're not done, right? They're not done on the job on inflation, especially Fed Daily coming out and saying, hey, we're not done. We still need to get to the 2% target. Also, a lot of other Fed members came out and said, hey, wouldn't be surprised to see if there is some stickiness or inflation picks back up. We got to be, looking at these things and be very careful when we're trying to hike rates, not too aggressively, but also trying to tame inflation. Basically paving the road and the path that obviously, as we already know, no rate cuts this year, but possibility leaving the door open for, maybe another rate hike or two this year. Now, in terms of rate cuts, which is very interesting, which you heard from some of the Fed members, they came out and they said, some of them came out and said, we leave the door open for rate cuts next year. That's a possibility, especially the beginning, early of first year. And when you look at what the markets are pricing in, right? What is the markets pricing in? That's very important. Now, when you look at the probabilities, the markets are basically pricing in a very low chance of probability of another rate hike this year. Now, when we look at the probabilities, we see here that there's about a 31% chance of a rate hike in November. So very low, so meaning that this might be the pause and no more rate hikes. And when we look at December, that number also remains around, actually below 31%, it's around 27%, right? So again, around that, close to that 30% mark. So again, hinting that, hey, this is it. This is the pause. And we're going to pause starting now till the end of the year. And then come January and especially March of next year, you got the probabilities more skewed out. There's 36% chance of a pause and a 36% chance of a rate cut. And as you go out through the months, you see starting in May, there's a very high chance that we're going to start to see rate cuts. Now, when you start to talk about rate cuts, when the Fed talks about rate cuts, and when you hear about markets trying to price in rate cuts, basically tells you that, hey, why would we get rate cuts? Does that mean that inflation has finally hit the target? And if so, is there something else that is causing that target or that number to come down? Because remember, when we look at the CPI number, especially the number that came out, the US number that came out on Thursday, the core number is sitting at year-over-year 4.7%, okay? And yes, the headline is 3.2%, still above the 2% target, slightly down. And yes, we came a long way from 9% down to 3.2. It doesn't mean that it's over here. And there's still signs of stickiness and still signs of certain areas of the CPI report that continues to be sticky and high up there, right? So when you look at the BLS website and you look and dive deep into the CPI index, into the report, it says here that 90% of the increase that was seen came from shelter. Again, still shelter being a big component of causing the inflation to be high up there. Now you can argue that, oh, shelter is up because the damn Federal Reserve continues to hike rates and interest rate costs is feeding into higher rent, higher shelter cost, etc., etc. But that's not the only component that is up. You also see food, motor vehicle insurance also contributing to the numbers as well. And when you look at food at home and food away from home, that is still elevated. When you look at the year-over-year number, food at home sitting at 4.9%, food away from home 3.6%. Now, on the other hand, energy has been completely collapsing, although, yes, crude oil prices and natural gas are starting to tick up, so we might see those numbers change in the coming reports, right? And it's going to be really important to monitor how energy comes out, because if those numbers continue to creep up and crude oil creeps up to $100 a barrel or higher, that's going to look really bad. And guess what? Central banks no way going to cut. Maybe even hike, I would say. So I would still argue another hike, right? So with the CPI report coming out as in line, it's still not done, because when you look at the core component sitting at 4.7%, still far away, the stickiness, the shelter component, the food, right? Food prices and whatnot. You look at also new vehicles, they're sitting at around 3.5%. Used cars have moved down, which is good, but vehicle prices are still up there. Medical care commodities still up there, 4.1%. When you look at also services, this is another big thing. Services is also still sticky. So services is up around 6.1% for the year. And, when you go out to restaurants or whatever services that you're taking out there, you're still seeing the effects of higher prices, because there's labor shortages, labor issues that are still in the markets, and people demanding still higher wages. And you do see that when you look at the non-farm payrolls report, the average hourly earnings, you're still seeing that stickiness, and especially wages tend to be very sticky and takes time for that to move down unless you have a very hard landing or recession. So that tells me one thing. Yes, great, CPI, no change, in line, but it's not done yet. There's no win here. I don't see this as a win. So in fact, I actually see this that, hey, we still need to see more data, and that's why September is going to be very important. When we get the next CPI report, when we get the next non-farm payrolls report, the next jobs number, the unemployment rates, the GDP number, etc., all the numbers coming out, and then you got the Fed meeting, and we'll see what they say then, right? And again, you still got October, you got November, you got December to still see how the data plays out. And if the CPI number is not coming down or shows stickiness or there's a pickup, then guess what? You can expect that next rate hike to come. Right now, the probability is 30%. That can very much change in the next coming months. So not a win yet, especially with CPI. Now, the PPI number that came out on Friday, also not a good sign. That caused stocks and bonds to move down. When we look at that, the PPI number came in higher than expected. Core PPI 0.3%. PPI looks at the producer price index, not at the consumer. So how are the producers feeling out there when it comes to inflation? The core PPI year over year 2.4% versus 2.3%, so a slight tick up there. The headline month over month higher as well. Headline year over year 0.8% versus 0.7%. So little tick up there on the producer price index. So not a big win. Not a big shocker also, and I would say, still need to be data dependent, and still there's a lot of risk for a tick up, especially when you're looking at the yields continue to move up, the bonds continue to sell off, basically telling you that, hey, this story is not done yet, right? If it was done, then you would see those yields come back down on those bonds, and you'll see bonds moving up because now they're signaling, hey, probably we're going to get the rate cuts or some sort of easing soon. And the bond market's saying, not really. And the stock market's saying, I'm a little bit worried. So you got both of them selling off. Anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video. And I'll see you guys around. Cheers, bye.